If you're navigating the ups and downs of supply chain logistics, don't worry, you're not alone. Let's dive into what happened during September 2025 and what it means for you and your business. This month, we're seeing the industry in a correction phase. Volumes are soft but stabilizing. Capacity is starting to ease, and the tariffs are adding an extra layer of unpredictability. But there's still pockets of opportunity if you're positioned right. I'll break down the Canadian domestic, cross-border flows, both northbound and southbound. Lastly, US domestic, so let's dive in. September stayed subdued for intra-Canada hauls, with load postings down a notable 12% from August. As back-to-school logistics wrapped up and industrial output in Quebec and British Columbia cooled amid softer commodity prices. Domestic volumes also slipped 11% month over month, pushing the truck-to-load ratio to 4.15, up 8% from last month and up a whopping 32% year over year. So what are the culprits? Lingering effects from summer rail strikes and a cautious pause in construction projects. Rates edged down slightly on the spot market, with carriers struggling to secure available freight. What's the forecast for Q4? Volumes should nudge up anywhere from 3 to 4% quarter over quarter, and that's supported by pre-holiday inventory builds in consumer electronics and apparel. However, keep an eye on currency fluctuations. A stronger Canadian dollar could temper import-driven demand, which leads to rate volatility. It's a gentle uptick, but focus on locking in reliable partners. Let's talk cross-border shipping. This is where things get interesting. With US policy shifts in play, let's look at northbound from the United States to Canada. Volumes held firm, climbing about 4% month over month, and that's supported by robust US outflows of pharmaceuticals and agricultural equipment to meet Canadian harvest needs. Now, southbound, Canada to the US, faced headwinds, with about an 18% drop in load postings due to tightened US inspections at Windsor, Detroit, and the ongoing de minimis suspension fallout, which has rerouted smaller e-commerce parcels to air and ocean. Cross-border over-the-road freight remains elevated, but September's compliance hurdles nudged spot rates up 2 to 3%. So what's the forecast for Q4? Northbound flows could expand anywhere from 5 to 6% as US holiday exports accelerate. Southbound, more cautionary. Despite a 1 to 2% volume pullback, if US MCA review talks drag, rates may rise anywhere from 4 to 6% to cover added paperwork and detention fees. The opportunity lies in utilizing pre-clearance programs. Let's talk US domestic shipping. Down south, September marked a tentative recovery from summer, though volumes dipped another 4 to 5% month over month. As consumer spending eased, industrial shipments took the brunt amid some tariff noise and inventory destocking, while retail held marginally better. Spot rates reflected this caution. Dry van down 0.8% from August, reefers down 2%, but flatbeds ticked up 1% on infrastructure projects. Capacity overhang persists. The DOT's move to enforce stricter residency rules aims to phase out around 194,000 non-domiciled CDL holders, which will tighten the driver pool. So what's the forecast for Q4? Volumes rebound with 2% growth, as per American Trucking Association estimates, fueled by Black Friday prep. Rates should rise. Dry van and reefer by 2 to 3%, flatbed 4 to 5. The CDL purge could accelerate this, creating spot shortages in high turnover regions like the Midwest. Hurricane recovery in the Gulf adds another layer of regional spikes. Forecast and get ahead of the uncertainty.